Hey folks, Jordan with my strategic forecast Inside the Numbers Live. And I want to do something a little bit different for you all today and talk about options and implied moves because there's a really fascinating study here that can help you understand the market at a deeper level. Now, most of us are familiar with options to some degree. We know they're leverage contracts that come with a specific strike price, the price that the option can be executed at, and we know that they have an expiration date. That's how long the options contracts are valid for. And most of us are familiar that calls, when you buy them, are bullish bets on a stock, and puts are bearish bets when you buy a put contract. So, for example, a call option on the SPY to buy the SPY at $420 that expires in 2 days would cost me 56 to 57 cents, or about $56 to $57 in total, because each contract carries 100 shares. So you multiply the price by 100. Now, it doesn't cost all that much because the current price of the SPY is around $414.45. And I would never want to execute a call option and buy shares from somebody else at $420 when the price of the SPY is currently trading below that. However, once the SPY gets above that, then it creates value for me because I can then buy the SPY at the strike price and then turn around immediately and sell it back to the market. The put works very, very similar. It gives me the right to sell shares at a given strike price to the person that sold me the options contract. So again, if I look at the put option for $408, it's only running about 85 to 86 cents, or around $85 to $86 in total. And since the SPY is trading at $414.45, I'm never going to want to execute this because I would end up having to buy it at the current price, which is $414.45, and then sell it at $409. So I would take a loss. However, if the SPY dropped enough and fell below $409, then I could buy the shares at the given market price and turn around and sell them at a higher price than the market. And that's the value that comes with put options. In a sense, you can think of options as insurance or hedges against any volatility in the market. People buy them for the risk of a stock or an asset potentially rising, or an asset or stock potentially falling. Now, here's where things get interesting. The demand behind options can help us identify the market expectations by the options market of how far a stock is expected to move in a given range by expiration. Now, in this particular platform at Tastyworks, they actually put a nice little ruler where you can see where the implied move is. This tells us that the market expectations based on the options demand or implied volatility says that they expect the market to fall no further than about $409.50 or get no higher than about $419.25 within the 2-day period. And that gives us some interesting information because that comes to what's known as a distribution curve, which I want to show you here in a second. Now, you've probably seen a curve like this, and it's been called a bell curve or distribution curve before when you took math way back when. I'm not going to get too deep into it other than to tell you that when you look at an implied move, the implied move tells us one standard deviation, which says that the market's expectation is that 68.2% of the time, the closing price for that asset, so in this case the SPY, is going to fall within that implied move. Now, 2 times the standard deviation says the market's expectation is that 95.4% of the time it's going to fall within the implied move multiplied by 2, and so on with 99.7% at the 3 standard deviations. So let's see how that could be applied practically. So first, we need to understand how to calculate the implied move. It's actually very simple. All you do is come in and add up the price of the at-the-money call and put. So in this case, we can just come in and hit a straddle, and it'll tell us that the at-the-money call plus the price of the at-the-money put is $5.22. So the implied range is $414.45 less $5.22, up to $414.45 plus $5.22. Now, If we were going to look at 2 standard deviations, we would do it and multiply it by 2. So we'd take $10.44 and then add and subtract that to the $414.45. Now, here's where this information gets very useful. You'll notice this factor called delta. And delta for the put options ranges from 0 basically all the way up to -1. And the at-the-money options for puts are minus 0.5. Call options run the same gamut except they go from 0 to +1, and at-the-money options are 0.5. You can think of delta as the equivalent number of shares that you control. Now, every time that a market maker sells us an option, they immediately go in and offset it. So if they were to sell me a call option for the SPY for $414, they would immediately go out and buy the equivalent, which is about 50 shares of the SPY. And that way they would immediately offset what they just sold me. It's a simple matter of how they transact and work their game. Where this gets interesting is when you get huge moves overnight where a stock or a market is opening up more than 2 standard deviations, so 2 times the expected move, higher or lower. That leaves the market makers completely underhedged because they were only planning for that to happen, say, less than 5% of the time, because 95% of the time they would expect it to stay inside of the 2 standard deviations. So when it falls outside 2 times the standard deviations, or in this case 2 times the implied move, it creates a scenario where the market makers have to immediately come out there and start either buying shares if the stock is gapping up too much, or shorting shares if the stock is gapping down too much. That can create a scenario where you have excess movement in the stock that can cause a gap and go either to the high side or the downside. Now, I want to show you a practical example of how to apply this. So let's take a look at when Netflix had earnings, and in fact this is one of the stocks on the move. Now, you can see here that Netflix closed around $350 the day before. When earnings came out, they were bad, and the markets did not like them. And while this isn't exact, the expected move was only supposed to put them down at maybe $300, a little bit more. So 2 times the expected move took them down to about $260. The stock opened up closer to $250, so it was well beyond 2 times the expected move. And even though it had great support levels identified for the stocks on the move, the downward pressure from the market makers sent this stock straight down for nearly 45 minutes straight. There was hardly any upticks at all. And this is one of the pieces that you can add on to some of the trades that you take to help you identify when there might be higher risk trades for stocks on the move. Conversely, you can also use these to play gap and goes, where you may come out of the gate and you may short Netflix or buy puts out of the gate and use those to generate some additional trades that you might find interesting for intraday action. This is just another snippet of some of the information that is reserved exclusively for Inside the Numbers Live members. Not only do you get a chance to see somebody trade the stocks on the move and the S&P 500 live, but you get additional trades and insights to help you develop your own strategy and become a better trader overall. We offer a 7-day free trial for anybody that's interested, so you can check it out and make sure that it's right for you. My name is Jordan with My Strategic Forecast Inside the Numbers Live. Thanks for joining me.